Today, we're going to dive into a question that sounds super simple, but is actually one of the most misunderstood ideas in all of modern economics. So let me ask you, where does money really come from? Now, if the first thing that pops into your head is a giant printing press, churning out banknotes, well, you're not wrong. But, and this is a big but, you're only seeing a tiny, tiny piece of the puzzle. The truth is, most of the money out there isn't physical cash at all. In fact, get this, in a modern economy like the UK's, and this holds true for most developed countries, all those physical banknotes and coins, they only make up about 3% of all the money. Just 3%. So what about the other 97%? Well, that's something else entirely. It's the digital money that lives in our bank accounts. So the big question is, if it's not being printed, where on earth is it all coming from? Okay, to really get this, we need to split money into two categories. First, you've got what's called central bank money. This is the physical stuff, the banknotes and coins created by a country's central bank. You can think of it as the foundation of the whole system. And yeah, that's our 3%. But then you've got commercial bank money. This is all the digital money in our bank accounts, and it's created by the commercial banks you and I use every day. And that is the other 97%. All right, so how is this commercial bank money actually made? This is where we run into a really common misconception. I'm talking about an idea that's still floating around in a lot of economics textbooks, even today. It's this theory called the money multiplier. And the story goes something like this. Let's say you deposit £100 in a bank. The bank holds on to a small piece of it, say 10%, and then lends out the other £90. Now, the person who borrows that money goes and spends it, and whoever they paid deposits it into their bank. That second bank then keeps 10% and lends out the rest, and on it goes. The idea is that this process multiplies the original deposit across the whole economy. It makes a certain kind of sense, right? But it's just not how it actually works. And hey, don't just take my word for it. Here's a quote from the Bank of England itself, and they say, pretty clearly, that the money multiplier theory is not an accurate description of how money is created in reality. So yeah, the people who actually run the system have moved way past this model, mainly because it gets the whole process completely backwards. So let's toss that old textbook idea aside and get to the real story. Let's find out how that massive 97% of money is actually created. And you might be surprised to find out that the reality is both way simpler and a lot more mind-bending. Okay, here it is, the single most important idea you need to understand. Ready? Loans create deposits, not the other way around. Let that sink in. Banks don't wait for someone to deposit money so they can lend it out. No. The very act of a bank approving a loan is what creates brand new money right then and there in the form of a new deposit. Let's break down exactly how this works with a simple example. Say a bank approves a mortgage for £100,000. They don't go into a vault and count out the cash. They just type the numbers into the borrower's account. That's it. Now look at the bank's balance sheet here. On the asset side, a new loan for £100,000 just appeared. That's an asset to the bank because it's a promise to be paid back. At the exact same time on the liability side, a new deposit for £100,000 is created. That's a liability because the bank now owes that money to the borrower. That deposit literally did not exist a moment ago. It's brand new money. There's a great term for this. Fountain pen money. It's this idea that new money is created simply with an accounting entry. Back in the day with a stroke of a pen, and today with a few keystrokes. Now, it's really important to get this straight. This isn't creating new wealth. It's creating new money. The borrower suddenly has £100,000 more in their account, but they also have £100,000 debt to go with it. Okay, so this probably brings up a pretty big question in your mind, right? If banks can just create money like this every time they make a loan, what's to stop them from just creating an infinite amount? Why not just lend to everyone for everything? Well, the short answer is no, they can't. Not even close. While the process is incredibly powerful, it's actually hemmed in by some very real-world limits. So what are these limits? Well, for one, banks are businesses. They're not just going to lend money for the fun of it. It has to be profitable. They also have to manage their risk. What if the borrower can't pay it back? Then there are regulations, rules that say they have to hold a certain amount of their own capital. And maybe the most obvious one, you can't force someone to take out a loan. There has to be demand from people and businesses who actually want to borrow and are able to pay it back. But the biggest constraint of all? That's monetary policy. The central bank is kind of the ultimate referee here. By setting the main interest rate, they influence how expensive it is to borrow money across the entire economy. If they raise rates, loans get more expensive, fewer people borrow, and money creation slows down. If they lower rates, the opposite happens. It's their job to manage this whole process, to keep the economy on an even keel. All right, so we've covered a lot of ground. Let's boil it all down to the most important takeaways. So to recap, first, almost all the money in the economy, like 97% of it, is digital, living as deposits and bank accounts. Second, commercial banks create this money every time they make a new loan. Third, this isn't based on that old money multiplier idea of lending out savers money. And finally, this power to create money isn't infinite. It's limited by things like profitability, risk, borrower demand, and most importantly, by the central bank's monetary policy. And that leaves us with one last, really fascinating idea to chew on. If making a loan creates new money, just poof, out of thin air, what do you think happens when you start paying that loan back? Yep, you guessed it. The exact opposite happens. As loans are repaid, that digital money is destroyed. It vanishes from the system just as quickly as it was created. Something to think about.